oversight of the liquidity ratio, the leverage ratios, and many efficiencies and profitability ratios. So welcome participants, and I'm here to introduce Dr. Hatim, who will be here today for our session on webinar today. So Dr. Hatim is a very well-renowned analyst. He is a very dynamic lecturer with 4 years of very successful financial management experience. He has been an instructor, known for interesting lectures. It will be a very helpful today and with all his supporting materials and detail-oriented classroom management. He has been a very dedicated financial analyst to individual students' success and has a very comprehensive understanding and is customer-oriented. He has been general manager with 12 years of experience focused on increasing revenues and expanding the margins. So welcome Dr. Hatim today, and the platform for webinar today is yours. Over to you, Dr. Hatim Al-Sharif.
Hello, everyone. Good morning and Happy New Year for all of you. Wish you all the best in your life. First of all, I would like to thank Sanjita for this perfect introduction. As she said, I work in the oil and gas industry for almost 25 years, but also I started my education career after I successfully defended my DBA thesis in international finance and gained my doctorate degree from Isleska Business School here in Egypt. I have been a professor of finance for the past 4 years in various academies and institutions, both online and in campus as a freelancer. Also, I would like to thank Uni Atina team for giving me this opportunity to meet all of you in this well-organized webinar for the second time in the last 3 months. Today, as Sanjita mentioned before, we were going to tackle a very interesting and very good subject, which is financial ratio, your key to informed business decisions. In order to cover this subject, I will follow the following agenda. We will start, as usual, with the introduction, then meaning of financial ratio, and we will have a very good explaining for this financial ratio. Then we go to the uses, objectives, significance of the financial ratio, and then we're going to tackle very important notes when using a financial ratio or dealing with the financial ratio. For the time frame, I will only focus in 4 major categories of the financial ratios, just like liquidity ratio, solvency leverage ratio, profitability ratio, activity and turnover ratio. Then we will go to financial ratio analysis and interpretation. After that, we will go for the limitation of the financial ratio and end up with the summary or the conclusion. Finally, I will be open for any questions at the end of this webinar. Introduction. You know, the basis of financial analysis, planning, and decision-making is the financial statement, which mainly consists of 2 very popular statements, which is the balance sheet and income statement or loss profit statement. The income statement shows the operating activity of the concern during a specific period of time, which is normally 1 year, while the balance sheet shows the financial positions of the concern at a specific period of time. However, these statements contains numbers, figures, and do not disclose all of the necessary relevant information. For the purpose of obtaining the financial strength and weaknesses of the firm or the concern, it's necessary to analyze the data showed in the financial statement. In order to do that, we have these analytical tools for planning and decisions making, which is the financial ratio. But why we use ratio instead of numerical numbers? Simply because absolute numbers tell very little, while ratio express simply in one number the result of comparison between two figures. So the ratio make the comparison between two figures, or the relationship between these two figures in one number. Assume, I will give you to simplify this one. We have two companies, company A and company B. Both companies working in the same industry, but they supply the following information. Net profit for company A is 10,000, 10 million, whatever, will not, and for B, it's recorded 15 net profit. One can easily say that company B make most profit than company A. This is absolute right. But which company is the most profitable? Most profitable? To answer these questions, we will naturally call for further additional information relating to profit, such as size of company, total sales it generates, and how much capital is invested. So company B make the 15 profit from 100 total sales. So its net profit almost 15%. But company A total sales was 20. So in this case, company A will be most profitable than company B, because the ratio here says 50% net profit from its sales as a net profit. So absolute numbers tell nothing. Ratio, by comparing two numbers in the financial statements, can tell a lot. What's the meaning of financial ratio? Simply, ratio analysis is a process of determining and interpreting relationship, as I told you before, between the items of financial statements. Most or normally, we use an income statement and the balance sheet. Its purpose is to provide a meaningful understanding of the performance of the financial positions of the concern. Thus, it's a technique for analyzing the financial statement by computing ratio, as we saw in the last example. But also, absolute numbers tell nothing or tell a little. Also, ratio alone can tell a little. Ratio by itself, we said the net profit is 15%. What does that mean? Is it questionable? Is it good? Is it poor? We can answer these questions by either making the vertical analysis compare this ratio with the ratio from previous years to the same concern. And this is called time series analysis. So 2022, it was 15, while 2021, it was 13%. 2021, it was 10%. So this company have ongoing trend for their net profit. So this was the vertical analysis. On the other hand, we can compare this 15% to the leaders of the market in the same industry. And this, we will call it horizontal analysis or external cross-sectional analysis. So company A, net profit 15%, company B, net profit 10%, company C, net profit 20%, then we can ratio tell me that company C is the most profitable company in this industry at that time. A ratio by itself, as I told you, now we tackle this point, no problem. Now we're gonna do uses of the financial ratio. Knowing what financial ratio is not enough. We should also understand how to implement it in a business for your benefit. For example, we have a lot of categories of financial ratios. When you use these financial ratios, you should know what this ratio actually measure, how it be calculated. What does that mean? What does that ratio actually tell us? So it's not an easy task to make the financial ratio. Maybe it's an easy task for mathematical way, but in a financial way, we need to know how to implement what you are looking for. What you are looking for, a solvency of the company, you are looking for the liquidity, you are looking for the profitability, the turnover, what you are looking for exactly. Each user of the financial statements of the enterprise or the company have its own goal. He searching for specific information. Knowing his specific information, he can use and calculate these financial ratio. So financial ratio enable company to track, as I told you, its performance with the vertical analysis, and allow company to make comparative judgment regarding its performance with the cross-sectional analysis or horizontal analysis. As I told you, users of the financial ratios are, we can make two groups of users: internal users and external users. For the internal users, financial ratio analysis can tell us or can be useful for planning for the future, setting goals, evaluating the performance of manager. How we can evaluate the performance of manager? We setting goals or planning for the future that the net profit of the company increased to 15%. We do the financial ratio analysis and evaluate the performance of the manager and compare it with the goal of the 15%. Did he achieve the goal or he far away from the goal? For the external purpose, we can use this financial ratio to decide whether to grant a credit, as investors and creditors. We also monitor financial performance of the enterprise, forecast financial performance, decide whether to invest in the company. Each one, I will have to calculate some set of ratios. For grant credit, the most important things for the creditors is the solvency of the company. Can she pay its obligations by using its current assets or not? This is for example only. What are the objectives of the financial ratio? Financial ratio, interpreting the financial statements and other financial data, is essentially for all stakeholders of the entity. Ratio analysis become a vital tool for financial analysis and financial management. So let us take a look of some objectives that ratio analysis fulfill. First one, measuring for the purpose of profitability. What is profitability? Is the ability of business to make profit. To what extent this company is able to make profit by using its assets. It used to measure profitability in various ratios such as net profit, gross profit, and expense ratio. We will show this after a while. Second objectives, measuring efficiency. Operating ratio are calculated for the purpose of measuring operating efficiency of the business. So as if you recall or concentrate with me, you see that each objective, as I told you before, I must know what are the purpose of analyzing this financial statements in order to use the right ratios. It measures also the solvency of the business. What is the solvency of the business? It's the ability of business to pay debt, as they come due. This is the solvency. Solvency ratio establish the relationship between the total assets and the total liabilities. It helps to show whether the firm have enough assets to fulfill its debt obligation or not. The firm has enough assets will be considered solvent, of course. Number 4, it measures the financial status of the company. Fixed asset ratio, here we are talking about the fixed asset ratio. Debt to equity ratio come under this category. These ratios are used to determine the financial status of the company. Also useful for determining and comparing the long-term and the short-term financial standing of the firm. There are long-term by using its long-term assets or fixed assets, and the short-term by using long-term financial status by using the loans, bonds, short-term, current, and liquidity ratios. Okay. Finally, it's useful, or one of the major objectives of the financial ratio is for comparative analysis. By the cross-sectional analysis, ratio can be used to making temporary comparison between the performance of the business. Can also be used to compare two business having similar or different features. This analysis helps in determining the strengths and shortcomings of a business. But take care, when you are going to the cross-sectional analysis, one of the misleading information you will face is the size. Of course, we compare between two companies in the same industry. This is for sure. I cannot compare Facebook with Mercedes-Benz. This is not a fair comparison. Okay, so I should compare two companies in the same industry. But in the same industry, you will not have a very identical companies. The assets or the size of the company in the same industry will be different. So make sure when you are making the comparative analysis with your peers in the industry, take in consideration the size of the company you are comparing with. What are the significance of financial ratio? Ratios are exceptionally useful tools with which one can judge financial performance of the enterprise over a period of time, because we use ratio to facilitate reading and understanding the financial statement of the concern. The efficiency of the enterprise can also judge against the industry average, and vertical analysis ratio help the analysis to form a judgment whether performance of the firm at a point of time is good, questionable, or poor. Likewise, use of ratio in horizontal analysis indicate whether the financial conditions of the firm is improving or decreasing, and whether the cost, profitability, or efficiency is showing an upward or downward trend. At times, investment decisions are based on conditions valued by certain ratios. In this way, it serves a handmaid to the management. Let us take a look about the significance, some significance of the financial ratio. Of course, it's more or less like the objective of the financial analysis, because the significance of the financial ratio, the first point, helpful in financial analysis. It's one of the major tools for the financial analysis. We use the financial ratio. There is a lot of other analysis also can be used to analyze the financial statements, but the first step or the most important tool or technique is the financial ratio. It's also for planning financial strength. Various ratios such as net profit ratio and debt equity ratio may be used to expressing the financial health of the business, useful of locating the weak area. We are looking here for the strength of the concern, and here we are looking for the weakness of the same concern. Ratio analysis can be used for finding areas of weakness, such as a high ratio of expenses or an increased in debt. These are the weaknesses. When we find high ratio expense, low profit ratio, net profit ratio, these are one of the weakness of the company, so the management can work to improve this weakness and also to maintain this strength. It also helps for future planning or forecasting. Financial ratio can be used for purpose of future planning and forecasting, by the way of the budgeting, when we call it about budgeting. It's also for inter-firm comparison. I can make a comparison internally in the firm itself. Suppose the firm has 2 or 3 departments or line of manufacturing. They are producing motorcycles, they are producing bicycles, they are producing cars. So we can make this financial ratio to comparison between these 3 lines inside the firm to show the strengths and weaknesses, and if we can have to decision to close one of these departments. Finally, assessing operating efficiency. Ratio analysis not only show a financial standing of the business, but also help in evaluating operational efficiency, and we will see later how we can evaluate operational efficiency. Now, we have a very important notes when dealing with the financial ratio. Cautionary points we must take care of them when we are using this financial ratio. The dates and duration of the financial statements being compared should be the same. Of course, I compare company A with company B with their financial statement for 2022. I cannot go for 2021 for B and 2022 for A. Should be the same. Also, I cannot compare half period or 6-month financial statements for company A with 12-month or 1-year financial statement for company A. So I should take care that the dates and duration of the financial statement being under study should be the same. The accounts to be compared should have been prepared on the same basis. One of the many most important concern is the accounting standards. Whether the company is under study using the GAAP or the IFRS. Of course, the results will be, there will be a misleading in the comparison between companies using GAAP and companies using IFRS. To identify trends, at least we need 3 years of ratio are normally required to make the trend. At least I need 3 years to make this trend. Less than that, it will not be a trend. It will be, I cannot make the trend with two ratios, at least 3 ratios. Now, we are going to have a look at the major categories of the financial ratio. As I told you, for the time frame, I will not tackle all the ratios. I will get enough for these 4 categories and select 2 to 3 most usable ratios from each category for the time frame purpose. The first category is the liquidity ratio, solvency leverage ratio, profitability ratio, activity turnover ratio. These are the most popular categories of the financial ratio, or the most used categories of the financial ratio. Liquidity ratio. This is the first one of the category. These ratios are used to determine the short-term solvency. In other words, it analyzes the firm's ability to meet its current obligation. What are the current obligations? Bank overdraft, also the suppliers or vendors, so this is short-term solvency. The most popular ratios under this category is the liquid ratio, absolute liquid ratio, and the current ratio. Liquidity itself is the ability of the business to meet its current liabilities. This measures short-term strengths of the business. The ratio can also assess the liquidity of current assets held by the business. Current assets should be liquid or near liquid to meet short-term obligation. You know that the assets, the current assets in the financial statements organized from the liquid and above. We start with cash in bank, cash in hand. This is 100% liquid. Cash in bank, the liquidity is 99% because I need time to go to the bank, issue the check. There's vacation after the working hours. So this is cash in bank is less liquid. Deposits, less liquid. Inventory, less liquid. So I should meet my current obligations by the most liquid current assets, which is cash in hand and cash in bank. We have two ratios for the liquidity ratio. The current ratio, it's also known as the working capital ratio. And it's used for determining the short-term financial position of the firm. Simply, it's done by matching the total current assets with the total current liabilities. Of course, it goes without saying at the same time period. The formula, very simple. We'll take the current assets divided to the current liabilities. This is the current ratio. Quick or acid test or liquid ratio is also known as liquid or acid test ratio. The quick ratio is used to determine the short-term solvency. Here in the current ratio, we are looking for short-term position. In the quick ratio, we are looking for the short-term solvency. It describes the relationship between the current liabilities and the quick assets. The quick ratio measures the firm ability to meet its current obligation. This ratio is generally used in conjunction with the current ratio. How we can calculate it? Quick assets divided by the current limits. But what are the quick assets? Current assets, we all know the current assets. What are the quick assets? The quick assets equal the current assets minus stock plus prepared expense. These are the quick assets. Because quick assets have the characteristics of easy conversion into cash. Second category of the ratio is the leverage or solvency ratio. This ratio determines the extent to which an enterprise make use of borrowed money. How they borrowed money. The main ratio included under this category are debt to equity ratio, proprietary to equity ratio, interest coverage ratio, capital gearing ratio. This ratio analysis also deals with the long-term solvency positions. So here we are talking about the long-term solvency. Leverage ratio deal with the long-term solvency, while the current ratio or the liquidity ratio deals with the short-term solvency. We will gonna tackle 3 major ratios under this category. First one is debt to equity ratio. This ratio also known internal equity ratio. Internal equity ratio. This ratio used to determine the efficiency of the firm's long-term financial planning. The ratio shows the relationship between equity funding and debt funding. Simply, its formula, we're gonna take the total long-term debt divided by the shareholder funds or the equity. Proprietary ratio. This ratio establishes the relationship between owner's fund and the total assets of the business. The main purpose of this ratio is to determine the source for financing the assets. Most important to take notes about what each ratio tells us, plus, of course, the formula, and also why we or when I can use this ratio for what purpose. Interest coverage ratio, or it's called debt service ratio. This ratio establishes a relationship between the interest on long-term debt and net profit before interest and tax. It's useful determining the capability of the business in meeting its fixed interest obligation for its long-term loans. Formula, we're gonna take the net profit before interest and tax divided interest on the long-term debt only. Third category of the ratios, the profitability ratio. Gross profit ratio, net profit ratio, rating ratio, expense ratio. are some of the main examples of the profitability ratio. This ratio calculates the overall performance of the business by using ratios such as return on equity, market capitalization ratio, price earning ratio. All these ratios under the profitability ratio. Profitability ratio measure the performance of the company. It requires profit not only for survival, but also for expansion and diversification. Profit can be used for determining the efficiency of management and employees. Also useful for providing security for creditors. Of course, creditors will not give loans to company that they cannot make profit. In this category, we have four major ratios: gross profit ratio or gross margin ratio. This ratio is generally expressed in percentage and show the relationship between the net sale and gross profit. So it's formula: gross profit over the net sales times 100 in order to show it as a percentage. Net profit ratio, it's calculated by dividing the net profit over the net sales times 100. Here are the gross profit, the net profit, the gross profit and the net profit. When we go to the income statement, sales minus COGS equal net profit minus administration and sales expenses minus depreciation equal net profit before tax and interest. Operating ratio, it's calculated by dividing the cost of goods sold, COGS, plus operating expenses, divided to the net sales times 100. This ratio measures the relationship between sales and the expenses incurred for making such sales. Earning per share, the last ratio in this category, calculated by net profit after tax, interest, and preference dividend, divided by the number of the equity share to make the earning per share. And this is mostly used on the stockhouse. Last category of the financial ratio, activity turnover ratio. These ratios are calculated to assess a firm's efficiency in employing its assets. These ratios are also known as the turnover ratio, activity ratio, the same meaning. These ratios calculated the velocity with which assets are converted into sales. Calculating the assets of the firm efficiency in employing its assets by converting the assets into sales. These assets need to be managed efficiently for the purpose. Pattern management assets help to generate higher profit for the business. This activity ratio is also known as the turnover ratio. The most popular ratios: fixed assets turnover ratio, debitor turnover ratio, stock turnover ratio. Fixed assets turnover ratio the fixed assets turnover ratio matches fixed assets with the sale revenue. This ratio shows the efficiency with which the business uses its fixed assets for the purpose of generating revenue and profit. The formula for this ratio equal net sales divided by the net fixed assets. Stock turnover ratio. This ratio also known as the inventory turnover ratio or stock velocity ratio or inventory turnover ratio or stock turnover ratio. So it calculated by dividing the cost of goods sold, COGS, divided by the average inventory. Total assets turnover ratio. This ratio is the relationship between the sales and assets. This ratio is used to measure the overall activity and performance of the business under study. The formula is very simple. We take the sales divided the total assets to make the activity turnover, the total asset turnover ratio. Financial ratio analysis and interpretation. Analyzing and interpreting financial ratio is logical when you stop to think about what the numbers tell you. As I told you, numbers, even ratio numbers or absolute numbers, tell a little. So stop thinking about the numbers, start thinking about the relationship between numbers. Start thinking about what kind of relationship you need to make in order to reach your goal. Start thinking about how can I understand the meaning of each ratio. When it comes to debt, a company is financially stronger when there is less debt and more assets. So the ratio should be, the ratio less than 1 is stronger than a ratio of 5. Company A have a debt ratio 1. Company B have a debt ratio 5 in the same industry. So company A is stronger than company B. Also, a high net profit ratio will ensure positive returns of the business. Cash flow management margin ratio calculated how well a company can translate sales into actual cash. This is the cash flow ratio. Calculated by taking the operating cash flow and dividing it by net sales found in the income statement. Higher the operating cash flow ratio or percentage is, the better. Nothing in the world are perfect. Every theory, every formula, every practice we take, every decision we take, everything we do in the life has pros and cons, has a limitation. So what are the limitations of the financial ratio? I will not tackle all the limitations because it's more than 20 points. I will focus only on the major 6 points making the financial ratio limited or not accurate as it should be. The first one, false results. I will explain each point. Limited utility of particular ratio. No fixed terminology. No attention to qualitative factors. Overlook inflation. Misleading results. For the false results, what are the basis of the financial ratio calculation? It's the financial statement. So, if you are sure that the financial statements represent the accurate positions and performance of the company without any fraud, without any misleading figures, so the financial ratio will have a good tool to make the analysis. But as long as it depends on the financial statements, so the reliability of the ratio and its analysis depends on the correctness of the financial statements. Limited utility of particular ratio. In order to make comprehensive analysis, it's important to use different ratio. I cannot do one set of ratio. I cannot use the liquidity ratio without solvency ratio, without profitability ratio, without turnover ratio. I should, when I make an analysis for any purpose, I should make all of these categories, all of what kind of ratios that I can calculate it, I should calculate it in order to make a comparison of these results. It's not logic that the liquidity ratio for the company give a high or a good one, and on the other hand, the solvency ratio making the company poor. So I must compare all the results in order to put my hand on the misleading information if there, or miscalculation also. In order to make a comprehensive analysis, as I told you, it's important to use different ratio. Particular ratio may give misleading results. It's advisable to use various ratio for making meaningful and correct conclusion. For example, if I use gross profit ratio only, and the gross profit ratio shows that the company gross profit ratio is 25%, which is very interesting business to invest your money in, because the gross profit ratio is very high. But if you go scroll down the income statement and reach the net profit, maybe you will find it 10%. Oh, how? Because you miss to take in your account the administrative and sales expenses, depreciation, tax, interest. So when you look at the results, you can see that this company have something wrong in its net profit ratio comparing to the gross profit ratio. You might have a very high interest amount they should pay. This will lead to take sure that its solvency ratios and current liquidity ratios is fine or fair. Also, it might be because of the admin and sales expenses is very high, and this is can go to the expense ratio and evaluate the manager's performance. So do not use particular one ratio when deciding on a financial statement. Number 3, no fixed terminology. Ratio analysis is still evolving, and various terms by it interpreted in different way. This makes comparison difficult. For example, a ratio requiring the use of profit may be calculated using profit before tax or profit after tax. This may give inaccurate results. As I told you in the last examples, the net profit ratio, someone's use it ratio, profit after tax and interest, and someone use it before tax and interest. So the meaning of the net profit ratio itself, it will be misleading because there are no fixed terminology. 4, no attention to qualitative factors. As we know, all of us, that the financial statements itself has no attention to the qualitative factors, or you can't make the qualitative factors embedded in your financial statements. Ratio analysis quantitative and does not take in consideration the qualitative factors. This gives a one-side view. Overlooks inflations. For example, because of the inflation nowadays, the prices of the goods increased very high. Okay? When I compare the the net profit ratio or the turnover ratio assets, any ratio using the sales amount, it will not reflect the inflation. Last year's, I sell 1,000 piece of my product for $10. So my net sales $10,000. Because of the inflation, the price increased to 30. But the amount of the sold product decreased to 50. At the end of the day, the net sales increased to 3,500 to 15,000. These numbers and ratios using these numbers does not reflect the inflation, does not reflect the decrease of the sales. Actually, it's decreased. It's not for the performance of the management that they increase the net sales from 10,000 to 15,000. No. So it's overlooks inflation since ratio analysis does not pay attention to changes in the price level. The comparison does not serve many purposes. Last one, misleading results. Ratio analysis brings financial statements of different firms to the same level. Such analysis does not provide information about the size of their operation. I mentioned this point earlier, that when you are taking into the consideration when comparing between companies, the size of the company, because the size of the company will be reflected in the depreciation figure. Fixed assets will be more, so the depreciation expense will be more. The admin expense will be also more than the medium-sized companies. Now, we are reaching the conclusion of this presentation. Ratio analysis help to reveal, compare, and interpret silent features of financial statements. When applied to a set of financial statements, financial ratio highlight significant aspects of the financial positions and operational results of a business requiring further investigation. They help to identify the strengths and weaknesses of the businesses. In fact, ratio helps to evaluate the past performance, the present condition, and future perspective of the business. It enables us to ask the right questions about the business, but never tell us the answer. And it be a way to finding the useful answers, but never give us the answer. Such analysis, therefore, aids planning, control, forecasting, and decision making. Ratio help us to evaluate performance, structure analysis, show the connection between activities and performance. It's also, we can use it as a benchmark with past for the company, industry with a cross-sectional analysis. Ratio adjust for size differences. This is one of the main issues when we are talking about the ratio. Thank you all for your attention and hope you enjoyed the session and improve your understanding of the financial ratio pros and cons. Now I'm open for any questions.
Thank you, Dr. Hatim, for such a wonderful session and such a lovely insight. I believe our 400 and above participants will be understanding, and they were all over the chat saying thank you for such an insightful presentation and learnings. So there are lots of queries and there are questions also. So in the meantime, Dr. Hatim, I'll take 5 minutes of your time to present about UniFINA, and you can go over to Q&A sections. There are questions which you may pick up in the Q&A sections, and we'll go by one in the Q&A sections. So, Dr. Hatim, can you please allow me to present my presentation? You can close the slide.
Okay. I should close the slides. Okay.
Yeah, you can stop sharing the slides.
Okay. Hold a minute.
So all participants, wait for some time. Your questions will be answered by Dr. Hatim. So before that, I'll be presenting a short view about Uni Athena and its course. Please be online and please be present. Please don't leave, Dr. Hatim. You just can stop sharing the slide. Go to share screen and stop.
Okay.
Yeah, thank you.
No problem.
Okay, so to all participants all over the world, I welcome. And before we go ahead with the question and answer section, so let us first see what Uni Athena has courses about and what we can learn in Uni Athena. So our offerings, there are Uni Athena. So welcome to Uni Athena. And we have about more than 2.25 lakhs of learners, and we have more than 400 courses. So it's affordable, flexible, and accessible courses for all of the participants. And we are associated, and our partners are UCAM, Arbatra University, GMU, that's Marconi University from Italy. We have Acacia University from Arizona, and there are a few others who are our partners in these courses. So let me take you over to a brief view. We have Masters, MBA, Microcredit, and Doctorate courses. And the courses, there are short courses also, which are Basic, Essentials, and Masterings, MBA Essentials, and also Executive Diplomas and Diploma courses. So this about the learning in Uni Athena. It's 100% online, and we have bite-sized delivery. That means we go module by module and according to your pace. So what we do is that we have video lectures added by essential learnings. You can see the content and you can see the additional readings. We have e-resources also in the reference library. Yeah, we have reference materials in the e-library sections also, which will be accessible for you once you get enrolled. So visit us, visit the Uni Athena Learn websites. I have shared it with you in the chat box. Please go through the chat box and you can see the link I have shared, and also Dr. Hatim's recordings. It's available in our YouTube channels. The link is shared to you. So please click on that link, and to other links also. There are recordings of other lectures also. You can listen to the recordings at your time and at your space. So over to Dr. Hatim for now. We will be answering some of the questions that our participants has posted. So let me check out. Okay, so Dr. Hatim, are you accessible to Q&A? Can you see
I'm reading the Q&A. There is a very good questions. One,
yes,
Abraham asked about, he want to know the difference between vertical ratio and horizontal ratio.
Great.
As I told you, as I told you in the presentation, the vertical ratio, when we take the financial statements of the concern and make the financial analysis for this financial statements for this year only, this is the vertical ratio. While the horizontal ratio, we have two kind of horizontal ratio analysis. When we compare the same company to make the trends in the last 4 or 5 years, this is horizontal analysis. Cross-sectional analysis also, when we compare the company with its peers in the same industry, this also horizontal analysis. I hope I answered your question. Idrissa Nabi asked about, he wants to know the difference between the balance sheet and income statement in financial ratio. There is, as I told you, the balance sheet tells us the financial positions of the company at a specific time, while the income statement tell us the operating activity for the company in a specific period of time. When we are using the financial ratio, we are using both statements, and some we can use also the cash flow statements, but the most important statements and most usable statements are the income statements and the balance sheet. So if you return to the ratios we have given to you, for example, total assets turnover ratio, it's sales over the total assets. The sales come from the income statements. This figure come from the income statement of the company, and the total assets come from the balance sheet. So there is no financial ratio only for the balance sheet or for the income statement. We use all the figures in hand showing on these financial statements to make this ratio analysis. And as I told you, do not depend on one particular ratio to make judgment of the company. I hope I answer your questions. What is the best tool of analysis financial statements by Idris and Abi also? We cannot say this analytical tool better than that. As I told you, the ratio analysis or any analysis have its own pros and cons. No analytical tool have only cons. Every analytical tool have pros and cons. So when you are taking a decisions, a fatal decisions, or planning for your company, you must use all available analytical tools and compare the results with each others in order to make the right decisions. Fandazzo Albert asked, do the quantum of the financial ratio vary across different industry or sectors where the lenders are using the same for the purpose of analyzing toward granting credit? What is the common benchmark they use? This is a very good question. Look, Albert, every industry have its own characteristics. So we cannot imagine a company work in a car industry with not much amount of fixed assets. We cannot imagine a company will manufacturing cars with low amount of fixed assets. On the other hand, in the media, we cannot imagine a company like a Facebook. When you're looking for the financial statements of the Facebook or Twitter, you will not be surprised when you saw the fixed assets is not that big amount comparing to the heavy industry. So each industry have its own characteristics. So the vendors or the investors or the creditors, when they grant credit, they usually make a benchmark for each industry in each year, in each conditions. So there is no benchmark valid for all companies. There is no benchmark valid for all years. There is no benchmark valid for all industries. Each industry at a specific time have its own characteristics with its own benchmark. I hope I answered your questions.
We can pick up a few more, Dr. Hatim.
Sorry?
We can pick up a few more questions.
Okay. Thandu, Nigidi, do these ratios have formulas? Of course, if you look at the presentation slides, you will find each formula for each ratio. Everyone, what is the best way to make notes without being left behind on the examples? How did profitability important to security? By no name for this attendees. What is the best tool to analyze financial statement? As I told you before, there is no best tool. You use all the tools or the techniques that you have in hand in order to reach the right decision. Can you advise us a good book for ratios interpretations? As I told you, the interpretations of the ratios, you cannot read it. You must understand. If you understand the ratio and the relationship between the figures in this ratio, you will easily can interpret these ratios. For example, I told you about the profitability ratio. The profitability ratio, it measures the company ability to make profit. When I told you this company A profitability ratio or net profit ratio is 50% and company B is 30% and company C is 20%. So it's easy to interpret that the company B is the most profitable company between its peers. So there is no a guidebook. A guidebook, you can go for any financial management analysis. You can also use CFA books if you have it. If you don't have, you can reach me on my WhatsApp number and the slides, and I can give you some interesting book for ratio analysis. Are these ratios important? Yeah. Are these ratios important for SMEs or for big companies? Ikina Emmanuel. Look, Ikina, these ratios important for the small companies because, as I told you, who are the users of these analytical tools? The manager itself, the employee itself, the owner itself. So the owner itself, if it's company, even it's very small company, he needs to make this analysis in order to judge his investment is going in the right trend, or he should make some changes in the management and the sales way and whatever the results will be. So these ratios are fatal for any enterprise looking for profit, despite the size. Small SMEs, big companies, big giants, multinationals, nationals, partnership companies, ownership companies, stock exchange companies, all kind of companies need to do this important analytical tool in order to judge their performance, plan for their futures, forecast their future. What is the main reason for companies to improve their business financial standing? By, it's not mention the name, but it's a good question. You can say what the main reasons. there is no only one reason. There's a lot of reasons to improve the business financial standing. You can find the weakness of the company in the management decisions or in the management chart of organization, or you can find the or can improve the business financial standing by improving their sales team, by improving their product, finalized product, the finishing of their product. A lot of reasons for companies to improve their financial standing. There is no only one issue. By issuing, let me tell you something. A company working in the industry with no debt obligation, is this good company comparing to other one with 40% of their assets coming from the obligations and 60% from the owners? You can find that the first company with no obligation, it's poor than the company with the obligation. Why that? The company that have no obligations, she cannot get an obligation. Her credit rating, its credit rating is very poor. So the creditors cannot guarantee any credit for this company because of this performance, this management history. So financial business, it's not a 1 + 1 = 2. It's a very complicated relationship between various of information, between informations, very complicated relationship between all the aspects of the business itself.
Okay, so Dr. Hatim, we'll take a last one questions. Last one questions, according to you, which would be more important one for all the participants to know. We'll take up one last questions.
Okay, I think Aya Danaf make a very good questions. Which combination of financial ratio categories are most powerful to consider hand in hand in order to come up to a reasonable, strong analysis? Look, Aya, as I told you before, in the limitation of the financial ratio, you cannot use one category to judge or take a decisions for your business or whatever the analysis you are looking for. There is no, you cannot use one category or a combined of categories to make this analysis. As I told you, the bond analysis, you can use it. Financial ratio analysis, you can use it. Technical analysis, you should use it. According to what you are looking for, according to the decisions you need to make, you should use all the ratios or all the analytical tool in your hand to make the best decisions, to calculate the best formula, to best understand these figures of this financial statements. So there is no particular categories to use for decision making. As I told you, I cannot say the company profitability ratio without the solvency ratio, because she is profitable, but she has a very big amount of obligations, and she cannot meet by its current assets. And also, all the ratios are very connecting with each other.
Okay.
Nagita?
All right. Okay. So that was a wonderful session, Dr. Hatim, and thank you for coming here and giving your insight into such an important webinar that we had. And we thank all the participants who had been listening to your wonderful lectures and insightful lectures. I hope all the participants got their queries also answered by Dr. Hatim. Dr. Hatim from Uniatina team, I thank you. Thank you for your time. Thank you for your valuable answers and also the insights that you have given to the participants. Thank you, Dr. Hatim. And thank you.
Thank you, participant. Thank you, Sanjita. And hope you enjoy the sessions. Any further questions, you can contact me on the contact details and the presentation. Thank you and see you next time.
Great.
Bye-bye.
Thank you. Bye. Bye, everyone. Bye.